The closing bell rang exactly 15 minutes ago. The cash market is locked, and we have the final scoreboard. S&P 500 closed up 0.6%, settling right near 7,437. NASDAQ pushed up 0.7%, and the Dow Jones managed a 0.6% gain.
Yeah, I mean, you look at those closing prints on the surface, and it looks like a clean, healthy breakout. But it is an absolute head fake.
Right, because if you actually dig into the internals, the institutional money was quietly hitting the panic button, going right into the close.
Exactly. What we saw today is a tape completely divorced from the reality of what the average stock actually experienced. It's a statistical optical illusion.
So we're going to deconstruct exactly why that is. We are looking at a fierce, contradictory tug of war right now. You have mega cap tech earnings on one side and surging bond yields on the other.
And honestly, the index numbers are essentially lying to you. To figure out the narrative here, you really have to look at the massive divergence at the very top of the food chain.
Right, the mega cap illusion. So let's unpack the tale of two completely different tech giants today. You look at Amazon, the stock just rocketed upward, up 15%.
Just a gravity-defying move.
Yeah, massive. And the catalyst is AWS accelerating to 37% year-over-year growth. Plus, their custom AI silicon, the Trainium chips, they just passed a staggering $25 billion run rate.
Which is, an incredible fundamental validation for them. I mean, for the last year, the whole market has been asking if the billions of dollars spent on AI infrastructure were actually going to pay off, right?
And Amazon basically just handed the market a $25 billion yes.
Exactly. They are proving the actual return on investment. They're showing proven immediate cash flows.
But then you look across the street at Apple, and it's a completely different universe today. Apple tanked, down roughly 7 to 10% following an earnings report that was just, it's brutal.
Yeah, a total key reversal on the charts. Weaker forward guidance, huge misses on China revenue, and some major supply constraints.
So here is where the math feels broken, if you're just looking at the headline numbers. Apple is a multi-trillion-dollar company. If it drops 7 to 10%, hundreds of billions of dollars in market value just evaporate.
Right.
How can the broader market be up when a foundational pillar like Apple takes one of its worst single-day market cap hits in history?
It all comes down to the mechanics of market cap weighted benchmarks. Our major indices, the S&P 500 and the NASDAQ, they are not democratic. Every company doesn't get an equal vote.
Right. A company's influence is strictly dictated by its size.
Precisely. And Amazon is a behemoth. So when a company that size has a 15% explosive upside move, it generates this mathematical force that can basically single-handedly pull the index higher.
Even with Apple acting as a massive anchor.
Yeah, because Amazon's absolute dollar value gain combined with sympathetic buying in other cloud leaders, guys like Microsoft and Alphabet, who benefit from Amazon's cloud data that mathematically overrode Apple's drag.
So the sheer weight of that cloud momentum forces the headline index numbers into the green, completely masking the rot underneath.
Masking it entirely.
Which brings us to the internals, right? Because if Amazon and a couple of its peers are doing all the heavy lifting, what is the rest of the market doing?
Oh, the internal breadth was atrocious.
We have the internal market breadth data right here. The advanced decline ratio came in at a dismal 0.6 today.
That is the real tell. A 0.6 advanced decline ratio means that for every 10 stocks that actually managed to gain ground today, nearly 17 lost value.
Wait, so if nearly twice as many stocks went down as went up, calling today a market rally is just bad math?
It's an optical illusion. A true, healthy market breakout needs broad participation. You want to see volume confirmation across multiple sectors. What we saw today was a highly targeted mega-cap rescue operation.
So the real money actually faded this rally?
Without a doubt.
Yeah.
If you strip Amazon and a handful of semiconductor heavyweights out of the equation, the average stock in your portfolio bled out today.
And we can see that vividly in the sector performance data. Consumer discretionary was technically the top sector today, but our notes point out that this is an illusion too. It's almost entirely because Amazon is categorized in that sector.
Right. It skews the whole bucket.
Meanwhile, real estate was the absolute laggard, just got crushed. And it wasn't just legacy sectors feeling the pain either. Look at the speculative tech space. Coinbase dropped 8% on heavy volume.
Yeah, that Coinbase print is highly revealing about institutional sentiment right now. They dropped on massive Q2 losses and a 21% drop in transaction revenue.
That 21% drop triggered aggressive, high-volume selling.
Because the market has zero patience for cash burn right now. It proves that institutions are ruthlessly punishing any company that lacks immediate, bulletproof cash flows. They're fleeing speculative, maybe someday growth plays.
And strictly concentrating their capital where the money is already being printed. But let's talk about the rally into the close, because the indices push even higher in the final 2 hours of the session. But looking at the volume confirmation and the closing notes, it just isn't there.
It's not there at all. Institutional desks are calling this a low to moderate conviction move.
Because of the calendar, right?
Context is everything. Today is Friday, July 31st. It is the end of the month. What you saw in those final 2 hours was largely a month-end rebalancing rush.
So it's just portfolio managers doing mandated housekeeping.
Right. Large fund managers have strict asset allocation rules. If cloud stocks ran up massively this month, they are mathematically forced to adjust their weightings. They lock in some gains, move capital around to hit internal benchmarks before the monthly books close.
So that late day push was just mechanical force buying, not organic enthusiasm?
No, the real money wasn't buying this close. And the reason they lack that broad enthusiasm brings us to the real risk here, the bond market.
The bond market bully. This is where the macro picture really asserts itself. The 10-year Treasury yield surged today, hitting roughly 4.70 to 4.74%.
Which is massive.
Yeah, yields act as financial gravity for stock prices. And 4.74% is heavy gravity.
It is. And we have to understand the mechanism behind that gravity. When you buy a growth stock, you are buying a claim on their future earnings. But if the 10-year yield goes up, the cost of borrowing money goes up across the entire economy.
And more importantly, the present value of those future corporate earnings goes down.
Exactly. Why take a massive risk on a company promising profits 5 years from now when the U.S. government is offering a guaranteed risk-free return of nearly 5% today?
It compresses the valuations investors are willing to pay, which perfectly explains why real estate got decimated today, since that sector lives and dies on borrowing costs.
Right.
But the macro factors driving this yield surge are critical. WTI crude oil pushed above $85 a barrel today, and the catalyst there is the ongoing geopolitical tension and hostilities in the Middle East, which is threatening supply chains.
And higher oil prices feed directly into sticky inflation metrics.
Right, if inflation stays high, bond yields have to stay pinned high to combat it.
And traditionally, those higher yields act as a massive headwind for rate-sensitive equities, especially volatile tech stocks.
But here's where it gets really interesting, because there is a massive divergence on the tape today. Usually, when yields shoot up to 4.74%, growth stocks get absolutely crushed. So why did companies like AMD and Micron defy gravity today?
It's wild.
I mean, we're looking at Micron up 18%, AMD up 13%, the SOXX semiconductor ETF up 8%, all at the exact same moment that yields spiked.
It is a glaring anomaly, but it is the single most important takeaway from today's closing print. It tells us something profound about current market psychology.
How so?
Well, look at high beta stocks.
Right.
Beta measures how volatile a stock is compared to the broader market. High beta names like AMD or Micron usually swing wildly. When borrowing costs spike, they should logically be the first to crash.
So why didn't they? Is institutional money just ignoring the fixed income signal?
They aren't ignoring it. They are reacting to it with extreme FOMO. The institutional money sees the high yields. They know capital is incredibly expensive right now. So they are panicking, fleeing anything that burns cash. But instead of hiding in cash or bonds, they are pivoting exclusively into the few proven AI hardware names.
Ah, so when Amazon declares their custom AI silicon is at a $25 billion run rate, the market decides that specific river of cash is powerful enough to outrun a 4.74% Treasury yield.
Exactly. Safety is no longer just a government bond. Safety is owning the company that owns the AI data centers.
That's fascinating, but historically, that kind of divergence can't last, right?
No, it cannot. Higher long-term yields ultimately compress all growth stock multiples. We are setting up for a violent showdown. Either bond yields must eventually fall to relieve the pressure, or this mega-cap tech momentum is going to face a very harsh valuation reality check.
You just can't have risk-free treasuries yielding nearly 5% without it eventually siphoning capital away from the stock market.
It's impossible long-term.
And we see that exact tension in the volatility data today. The VIX, the fear gauge, settled between 16.93 and 17.15 today. Despite the indices closing beautifully in the green, there was zero volatility crush.
None. Options traders refuse to price in tranquility.
Usually on a green day, the VIX drops because people relax.
Right, but today, they are actively hoarding insurance. Even as the S&P 500 drifted higher on Amazon's back, the smart money was looking at that 10-year yield, looking at $85 oil and deciding to keep their put options active. They do not trust the surface-level column of this tape.
Because they don't trust it, trading desks can't just buy a broad index fund and go to sleep next week. They are forced to trade the extremes.
They have to be surgical.
Which brings us to the look ahead. How are the big desks actually setting up for Monday morning based on this chaotic closing data?
Well, structurally, everything pivots to next week's macro data, specifically the non-farm payrolls report.
Right, all eyes on the labor market.
The market desperately wants to see cooling labor data to rein in those surging bond yields before tech earnings fatigue completely breaks the rally.
And looking at the institutional strategy notes, they map out a highly specific battleground for the S&P 500. There's a gamma wall and a key pivot zone sitting right between 7,434 and 7,466.
That is the critical zone for next week.
So if you're actively trading this, what does that actually mean? If I'm translating this correctly, 7,434 is the trapdoor and 7,466 is the ceiling. The market is basically trapped in a tiny claustrophobic room.
That is exactly the setup. When we talk about a gamma wall, we are looking at the invisible mechanics of the options market. Market makers, the massive institutions that sell options to funds, they don't want directional risk. They want to stay neutral.
So they have to delta hedge.
Exactly. They have to constantly buy or sell the underlying stocks depending on where the market moves to balance their books. Right now, if the S&P 500 holds above that 7,466 ceiling, options dealers remain in what's called long gamma.
And in long gamma, their mathematical formulas force them to buy stocks when the market dips and sell stocks when the market rallies.
Right. They act as shock absorbers. They dampen the volatility, which creates this slow, grinding upward drift that could eventually force the market higher toward 7,550.
But the real risk here is what happens if we fall through the trap door. What if a bad macro print pushes us below 7,434?
Then the math violently flips. The dealers enter short gamma territory. Suddenly, to hedge their books, their algorithms force them to sell into a falling market and buy into a rising market.
Which just exacerbates the volatility.
It creates a self-fulfilling downward cascade. If we lose 7,434, dealer selling accelerates the drop. The strategy notes target a rapid, forced sell-off toward 7,414 if that trapdoor opens.
The market is balancing on a knife edge right now. To navigate that, the notes outline one high-conviction setup, really two specific day two plays for Monday's open, entirely based on this mega-cap divergence.
Right, they're not buying the whole market. They are picking very specific targets.
The first setup is a long continuation play on Amazon, the catalyst being that massive Q2 revenue beat and the AWS growth. The playbook here is to watch for a morning dip, looking for a pullback to the $235 to $238 zone.
Because that specific zone represents structural support based on Friday's volume. If the stock pulls back to 235 and holds, it confirms that institutions are stepping in to reaccumulate shares.
They are buying the dip on a confirmed winner.
Yes. The upside target for that trade is $250. But crucially, they are cutting risk entirely if it falls below 230.
Strict execution. You do not hold and hope. And the second day two play is the exact opposite. It's a downside short play on Apple. They're looking for a bear flag or a dead cat bounce in the pre-market.
Right. A dead cat bounce is when a stock drops massively like Apple did and then experiences a brief, weak rally just because short sellers are taking profits, not because new buyers actually believe in the fundamental story.
So if Apple tries to bounce in the pre-market and fails to break through resistance on light volume, institutions are looking to short the stock on the way back down.
They are targeting structural unwinding, which means the core foundational holders of Apple stock are actively reducing their positions.
If we synthesize all this closing data, the core institutional thesis right now is the asymmetric trade. The money supply in the market is not expanding. It is just rotational, sloshing violently from one sector to another.
Yeah, long, untargeted equity exposure is dead money right now. You can't just buy a broad index and close your eyes. The risk-reward is an extreme stock selection.
You buy the pullbacks on confirmed AI revenue winners like Amazon, who have the sheer cash flow to withstand high borrowing costs, and you avoid or short the cash flow squeeze laggards.
Because that 4.74% treasury yield will eventually suffocate them.
So bringing it all together, do not be fooled by the green on the scoreboard today. We are looking at a market disguised by index momentum. The heavy lifting is being done by a few mega-cap cloud leaders, while underneath, market breadth is atrocious and the bond market is loudly sounding the alarm.
The tug of war between mega-cap tech profits and surging bond yields is the absolute defining structural battle of this tape.
Which leaves you with a final thought to mull over before the Monday open. If institutional capital continues to hyper-concentrate strictly into the few tech companies with massive AI cash flows, while simultaneously starving rate-sensitive sectors and punishing traditional businesses with nearly 5% borrowing costs, are we heading toward an economy of one giant, infinitely profitable cloud surrounded by 1,000 starving traditional businesses?
It's a dark picture, but looking at the breadth data and the yields today, it's exactly what the market is pricing in.
The scoreboard might be a mirage, but the gravity of those bond yields is very real. Keep questioning the closing prints, always look beneath the surface, and we will catch you on the next deep dive.